Ever felt like your tax return is, I don't know, like a secret language? Full of hidden pathways and cryptic clues, and you're just sure you're missing out on some hidden money you're actually entitled to. What if I told you there's maybe a shortcut? A way to understand exactly how to keep more of your hard-earned cash by, unlocking the power of deductions.
That is precisely our mission today. We're taking a deep dive into itemized deductions. This is a truly critical area of tax law. It can significantly influence your financial well-being. Our goal isn't just to explain the rules, but to break down the complexities into, well, actionable insights, reveal some surprising facts you might not know, and ultimately help you understand how these specific rules can work powerfully in your favor, potentially putting thousands more back into your pocket. We've meticulously combed through, a comprehensive stack of official sources, detailed research, and real-world examples to be your expert guides through this often intimidating landscape.
Okay, let's dive right in then. Let's unpack this core decision that impacts nearly every single taxpayer. Do you take the standard deduction or do you itemize? It really is the first major fork in the road on your tax journey, isn't it? And making the right choice here, right at the start, can make a profound difference to your bottom line. It's not just technical, it feels like a strategic choice.
It absolutely is. Think of it this way. The government offers you two main paths to reduce your taxable income. One is straightforward, a predetermined amount. That's the standard deduction. The other is where you list out specific eligible expenses you've incurred throughout the year, and that's itemizing. Taxpayers choose to itemize deductions when they're eligible from AGI deductions. And just quickly, AGI stands for Adjusted Gross Income. Basically, your total income minus certain specific deductions like, say, traditional IRA contributions or student loan interest, when those from AGI deductions exceed the standard deduction amount. All these individual itemized deductions are meticulously reported on Schedule A of your Form 1040. It's specifically designed for this. It's essentially a mathematical threshold. If your eligible expenses and contributions are high enough, it makes practical, financial sense to go the extra mile and list them out. If not, the standard deduction is your simpler and often better path.
Right. So it's not just about having a lot of expenses. It's about having enough of the right kind of expenses to clear that specific bar, that threshold you mentioned. You need to gather those receipts, those records, and really see if they add up.
Exactly. And here's where it gets really interesting and often surprises people, especially married couples who might be thinking about filing separately. There's a crucial, often overlooked rule. If you are married and filing separately, both spouses must either take the standard deduction or both must itemize. You can't mix and match.
Oh, wait, really? One can't take the standard and the other itemize?
Nope. One cannot do one and the other the other. This isn't just a quirky rule. It's a critical insight for married couples. It fundamentally means that individual tax decisions can't be made in a vacuum. It underscores the absolute necessity of joint tax planning, even if you ultimately choose to file separately, to ensure you're not leaving significant money on the table because of this one constraint. Imagine one spouse has, say, really high medical expenses that push them over the itemized threshold, while the other has virtually none. If the first spouse itemizes, the second is forced to itemize too, even if their own itemized deductions are far below their standard deduction. That could potentially cost the couple overall. So coordination is absolutely key.
That's a huge point. Wow. It really highlights the need for coordination. Like you said, it's a classic tax trap if you're not aware of it. Okay, so let's talk about the standard deduction itself.
Right.
What are the baseline figures we're trying to beat if we're considering itemizing? What's the benchmark for, say, 2023?
Okay, for the 2023 tax year, the standard deduction amounts are, for single filers, it's $13,850.
$13,850. Got it.
For heads of household, it's $20,800.
Okay.
And for married couples filing jointly or surviving spouses, it's a substantial $27,700.
$27,700.
Right. And if you're married filing separately, it's that $13,850 again. But always, always remember that important caveat we just discussed about both spouses needing to, be on the same page. These figures are your initial benchmark. Your goal is to see if your eligible itemized deductions collectively exceed these amounts. If they do, then itemizing becomes the more advantageous path.
But I know the tax code often has these little extras for specific groups, like older taxpayers or those with disabilities. So what if you're over 65 or blind? Does that change things? Are there additional benefits?
Absolutely. Great question. The tax code is designed to provide additional amounts for taxpayers who are age 65 or over, or who are blind. And these aren't minor adjustments. They can genuinely increase your standard deduction and lower your tax bill. Let's break it down. For an unmarried individual, if you're 65 or blind, you add an extra $1,850 to your standard deduction for 2023.
Okay, $1,850 more.
If you're both 65 and blind, that increases to $3,700 extra.
Wow.
Now, for married individuals, if one qualified taxpayer is 65 or blind, you add $1,500.
1,500.
If that one taxpayer is both 65 and blind, it's an additional $3,000. And here's where it can really add up for couples. If you have two qualified taxpayers, say a married couple filing jointly where both are 65 or both are blind, you'd add $3,000 total, so $1,500 each.
Right.
And if both are 65 and both are blind, it becomes an impressive $6,000 total in additional standard deduction.
$6,000 extra.
$6,000 extra. This can often be the difference that pushes someone who might have otherwise itemized right back into taking the standard deduction simply because it becomes so generous.
Wow, that really adds up quickly. An extra $6,000 for a couple, that can be a significant difference for a lot of people. Can you give us a real-world example just to see how that works?
Sure. Let's consider Bob and Suzanne DeFilippis. They're a couple, both age 66, filing married, filing jointly. For tax year 2023, their standard deduction isn't just the base $27,700. Because each spouse is age 65 or over, they qualify for an additional $1,500 each, totaling $3,000 extra.
Okay.
So the combined standard deduction becomes $30,700. That's the $27,700 base plus the $3,000 in age-related additions. This example really brings home the point. Are you, the listener, capturing all the standard deduction benefits you're entitled to? Many people, particularly those approaching or over 65, might overlook these additional amounts. They're essentially leaving money on the table they could have used. It's a key area to check every single year.
That's fantastic. That extra $3,000 for Bob and Suzanne, that truly is a significant difference. What about other scenarios? Maybe someone who's blind but not necessarily over 65. How does that play out?
Good point. Let's explore that. Take Ed Joback, for instance. He's a blind, single taxpayer. If Ed is under 65, his standard deduction for 2023 would be $15,700. That's his $13,850 base, plus the $1,850 additional amount for being blind.
Okay, so base plus the blindness addition.
Right. Now, if Ed is 65 or over and blind, his standard deduction jumps further to $17,550. That's the $13,850 base, plus the full $3,700 for being both 65 and blind. These specific examples vividly highlight how these seemingly small additions can genuinely impact your overall tax liability, reducing your taxable income and, by extension, your tax bill. It's all about knowing these specific rules apply to your unique situation.
This is great information for individual filers and couples. But what about someone who's a dependent, like maybe a college student who's earning some money from a part-time job, but is still claimed as a dependent by their parents? How does the standard deduction work for them? That's a pretty common scenario.
Yes, dependents. For a dependent of another taxpayer, the standard deduction rule is indeed a bit different, and it's crucial to understand. For 2023, their standard deduction is the greater of two numbers, $1,250 or their earned income plus $400.
Greater of $1,250 or earned income plus $400.
Exactly. However, there's a cap. Their standard deduction is still limited by the regular standard deduction amount for their filing status, which is typically the single filer amount of $13,850 for 2023. So, for example, if a dependent taxpayer has, say, $1,300 in earned income, their standard deduction would be $1,700. That's the $1,300 earned income plus the $400. That's greater than $1,250. They'd use $1,700. But if they earned, let's say, $15,000, their deduction would be capped at the single standard deduction amount, $13,850. And here's another important point. Dependent taxpayers can also claim the same additional standard deduction for blindness and/or age 65 or over status, just like any other taxpayer, on top of their calculated dependent standard deduction.
Okay, so understanding all these standard deduction nuances, the base amounts, the extras for age and blindness, the rules for dependents, this is truly the first step in figuring out if itemizing is even worth considering for you. It's not just a simple choice, it's a calculated decision based on your specific circumstances. And this foundational knowledge is key, really, to unlocking potential tax savings. It truly is about being informed and asking the right questions about your own situation.
Precisely. You have to know the baseline before you can decide if you can beat it.
Okay, we've laid the groundwork with the standard deduction. Now, here's where it gets really interesting for many people: medical expenses. This can be a huge category for deductions, often representing a significant chunk of someone's itemized deductions, but it also comes with, well, a significant catch, right? What specific types of medical care qualify, and what exactly is that big catch we need to be aware of?
Medical expenses are indeed a substantial area, and yes, they offer a lot of potential for tax savings if you meet the specific criteria. Payments for medical care can qualify if they are made on behalf of the filing taxpayer themselves, their spouse, or a dependent. And what's often overlooked, kind of fascinating here, is that for this specific deduction, the definition of a dependent is actually slightly relaxed.
Oh, how so?
Well, for medical expense purposes, we don't consider the dependent's gross income or whether they filed a joint return. The other dependency tests, like support and relationship, still apply, but this subtle nuance means you might be able to include medical expenses for someone you significantly support, even if they earn too much money to be a traditional dependent for other tax purposes.
Huh. That could be a huge benefit for families supporting, say, adult children or elderly parents. Interesting.
You really could.
And timing is always important with taxes. When do these expenses actually count? Is it when the doctor sends the bill or when you finally pay it? Or maybe when you charge it?
You're touching on a key principle, the cash basis rule. For medical expenses, you can include amounts paid in cash or by check during the tax year. Critically, you can also include amounts charged to a credit card during the year, regardless of when you actually pay the credit card company.
Ah, okay, so the charge date is what matters.
The charge date matters, not the date you pay Visa or MasterCard. This principle also extends to payments made for a deceased spouse. Their medical expenses are deductible in the year they are paid, even if it's different from the year the spouse passed away. It's all about when the money effectively leaves your control for that specific expense.
Okay, now we often hear about this floor for medical deductions, meaning not all your medical expenses are deductible. How does that work? This is the catch you mentioned, right?
Indeed, this is the big catch, and it's a significant hurdle for many. Only qualified medical expenses that exceed both any medical insurance reimbursement and a 7.5% of your adjusted gross income, or AGI, floor, are deductible.
7.5% of AGI.
Right, so it's certainly not a dollar-for-dollar deduction for every single medical expense you incur. Think of your AGI as like a high jump bar. You first tally up all your qualified medical expenses. From that total, you subtract any insurance reimbursements you received. Then, from that remaining amount, you can only deduct the portion that exceeds 7.5% of your AGI.
Okay, can you give an example?
Sure, if your AGI is $100,000, your 7.5% floor is $7,500. So your qualified medical expenses, after subtracting insurance reimbursements, would need to be more than $7,500 before you can deduct even a single dollar.
Just if you had $8,000 in expenses after insurance, you'd only deduct $500.
Exactly. $8,000 minus the $7,500 floor leaves $500 deductible. That's a pretty high bar for many taxpayers, meaning only truly substantial medical costs will generally generate a deduction.
That makes it tough for many. So what specific types of expenses actually count towards that qualified medical expense total? Is it just doctor visits and prescriptions, or is it broader?
It's actually quite broad. A wide range of expenses qualify. This includes medicine and prescription drugs and, crucially, Medicare Part D premiums, payments to doctors, dentists, surgeons, specialists, also medical and accident insurance premiums, even qualified long-term care premiums, though those have specific age-based limits on the deductible amount. Medically necessary surgery is included, but elective cosmetic surgery, unless it's to correct an accident or deformity, generally is not.
What about getting to the doctor?
Good point. Transportation to a medical facility also counts. You can deduct actual costs or use a standard allowance, which for 2023 was 22 cents per mile, plus you can add parking and tolls. What's particularly interesting is that even expenses incurred by physically disabled individuals for moving structural barriers in their residences to accommodate a disability, like installing a wheelchair ramp or widening doorways, are treated as deductible medical expenses. That can be a significant deduction.
So it's not just the direct medical care, but costs associated with accessing it or adapting your home for it. That's a good insight. What about things that seem medical but might not qualify? Where do people often get tripped up?
Ah, yes, the non-deductibles. There's a surprisingly long list. Elective cosmetic operations, unless genuinely necessary due to an accident or deformity. Illegal drugs, obviously.
Right.
Travel unrelated to specific medical care, like a general vacation taken for health reasons, won't count. General vitamins, even if you take them for wellness, are typically not deductible unless prescribed for a specific medical condition. The part of Social Security tax paid for basic Medicare, that's not deductible here. Funerals, cemetery lots, those are personal expenses. Insurance against loss of earnings due to sickness or life insurance premiums, no. Capital expenditures for medical purposes, like adding a permanent feature to your home, are only deductible up to the increase in the property's fair market value caused by that expenditure.
So if the improvement doesn't add value, no deduction.
Pretty much. General health club memberships, unless specifically recommended by a doctor for a particular medical condition, are out. And everyday personal hygiene items, toothpaste, over-the-counter cough syrup, diapers, maternity clothes, those are typically considered personal expenses and non-deductible. It's really about medical necessity, not general wellness or personal care.
That clarifies a lot of common misunderstandings. And how does insurance reimbursement specifically factor in? If I get money back from my insurer, does that reduce my potential deduction dollar for dollar?
Absolutely. Any amounts reimbursed to you by your hospital, health, or accident insurance must reduce your otherwise allowable expense before that 7.5% AGI floor is applied. So if you paid $10,000 in qualified medical expenses out of pocket and your insurance then reimbursed you $3,000, your starting point for the deduction calculation would be $7,000, not the original $10,000. This is a critical step. What's also important to note, and can sometimes be a surprise, is that if a reimbursement, say from an employer plan, exceeds the total medical or dental expenses you actually paid, that excess reimbursement will actually be included as part of your gross income.
Oh, really? So you could end up paying tax on the extra reimbursement?
Yes, and the same applies if you receive a reimbursement in a current year for an expense you successfully deducted in a prior year. That reimbursement will be included as gross income in the year you receive it under what's known as the tax benefit rule.
Okay, moving on from health expenses to another major area for itemized deductions, taxes, specifically state, local, and even foreign taxes. This is a big one for many, especially those living in high tax. It really changed the game for a lot of folks.
It did. And additionally, foreign real property taxes are generally non-deductible unless they are specifically incurred in a trade or business or for investment property. So that vacation home in Tuscany, its property taxes likely aren't deductible on your Schedule A.
That $10,000 limit is a real sticking point for many. So what specific types of state and local taxes are we talking about here that fall under this $10,000 umbrella?
Okay, let's break down the types that feed into that SALT cap. First, real estate taxes, state and local ones. You must be legally obligated to pay them to deduct them. If you buy or sell property during the year, these taxes are typically prorated between the buyer and seller. Taxes paid under protest are deductible, but if you later get a refund, that recovery is included in gross income, that tax benefit rule again.
What about things like sidewalk repairs?
Good question. Real estate taxes do not include assessments for things like street, sewer, or sidewalk improvements. Those are considered capital improvements that increase your property's basis, not deductible taxes. If you pay your real estate taxes through an escrow account with your mortgage, they're deductible when the escrow company actually pays the taxing authority, not when you make your monthly payment into escrow.
Ah, okay, that's a timing difference.
Yes. Foreign real estate taxes, as we said, generally only deductible if for a trade or business. Interestingly, real estate taxes on land held just for appreciation can either be capitalized, added to the cost basis, or deducted, your choice.
Oh, an option.
A small one, yes. And if a portion of your home is exclusively used for business, those specific real estate taxes might be deductible on Schedule C for business owners, not Schedule A.
Got it. So that covers property taxes. What about personal property taxes, like for my car registration?
Right. Personal property taxes, assessed by state and local governments on things like vehicles, boats, etc., are deductible if the tax is truly based on the value of the property and paid during the tax year. So, for your car's annual registration, if part of the fee is flat but another part is based on the car's assessed value, an ad valorem tax, only that value-based portion could be deductible under the SALT cap.
Okay, only the part based on value.
Yes.
And income taxes themselves. State and local income taxes withheld or paid.
Yes. Estimated state and local income taxes paid during the year are deductible in the year paid. Same for taxes withheld from your paychecks. Any assessments for a prior year's state or local tax that you actually pay in the current year are also deductible in the current year. But it's important to repeat. If you receive a refund for state taxes that you successfully deducted in a prior year, that refund is included in your gross income in the year you receive it. You do not net it against your current year's state tax deduction.
That tax benefit rule again seems important. Now, I've heard you can sometimes deduct sales tax instead of income tax. How does that election work and which one is generally better? Sounds like a strategic choice.
That's absolutely correct, and it is a key strategic choice, especially under the $10,000 SALT cap. You have an election. You can choose to deduct either your state and local income taxes or your state and local general sales taxes. You can't do both. This often raises the important question: which one is truly better for your specific tax situation?
How do you figure that out?
Well, if you choose to deduct sales tax, you have two options for figuring out the amount. You can either deduct the total actual general sales taxes you paid throughout the year, which requires meticulous record keeping of pretty much every purchase.
That sounds like a nightmare.
It can be. Or, the easier way, you can use the relevant IRS sales tax table. This table provides a standard amount based on your income, your location, and family size. And importantly, you can add the sales tax paid for specific big-ticket items like a new motor vehicle, a boat, or certain major home improvements to the IRS table amount.
So you add the big purchases on top of the table amount.
Exactly. Generally, if you live in a state with no or a very low income tax like Texas or Florida, or if you made a very large single purchase like a new car or RV during the year, the sales tax selection might be more beneficial. But for most individuals in states with moderate to high income tax, the income tax deduction will likely be the better option, up to that $10,000 SALT cap, of course. It really forces a calculation to see which provides the larger benefit within that overall $10,000 limit.
Okay, so you really have to run the numbers. We've talked about what's deductible under SALT. What taxes are definitely not on this list for Schedule A itemized deductions? Where might people mistakenly try to claim something?
Right. It's crucial to know what's explicitly not deductible as an itemized deduction on Schedule A. This includes any federal taxes.
Oh.
So no deduction for federal income taxes, no Social Security taxes, no Medicare taxes paid.
Okay, no federal stuff.
State inheritance taxes are also non-deductible here. And importantly, taxes related to a business are typically deducted on other schedules. For example, self-employment taxes or business-related property taxes go on Schedule C for sole proprietors, and rental property taxes go on Schedule E. They don't belong on Schedule A as itemized deductions.
Got it. Separate buckets for business and personal.
Exactly. And again, for cash basis taxpayers, the deduction is generally allowed in the year the tax is paid or charged.
Okay, let's shift gears to interest expense. This can feel like a minefield of deductions and non-deductions. It's often one of the largest itemized deductions for homeowners, but there are so many rules, and I know many listeners get confused about what counts and what doesn't. So what's fair game here, particularly with home mortgages?
You're absolutely right. Interest expense can be quite complex, and it is a major source of deductions for homeowners. For home mortgage interest, deductions are allowed for qualified residence interest on a first or a second home.
First or a second home? What counts as a second home?
A second home is a residence you use for personal purposes for at least 14 days in a tax year, or if it's rented out sometimes, for more than 14 days or 10% of the total days it was rented, whichever is greater. However, and this is a critical limitation many people miss since the tax law changes, you can only deduct interest on up to $750,000 of home-related indebtedness. That's $375,000 if you're married filing separately.
$750,000 limit on the loan principal.
Correct. Any interest on the principal exceeding that limit is treated as personal interest and is simply not deductible. Furthermore, the qualified indebtedness must be incurred specifically to buy, construct, or substantially improve your principal or second home, and so it must be secured by the home itself.
So the use of the loan money matters.
Absolutely critical.
Yeah.
This means if you take out a home equity loan but use the funds to, say, pay off credit card debt, buy a car, or even go on vacation, that interest is not deductible, even though the loan is secured by your home. The use of the funds is paramount. This trips up a lot of taxpayers who are used to the old rules.
That's a critical distinction. The use of the funds matters just as much as the collateral.
Wow. Okay. What about points paid when you get a mortgage? How do those factor in?
Good question on points. Points paid related to the acquisition debt on your home, meaning when you first buy it or build it, are generally deductible immediately in the year you pay them. That's a nice front-loaded deduction.
Okay. Deductible upfront for a purchase.
Yes. However, points related to refinancing an existing mortgage must be amortized or spread out over the entire period of the new loan. You can't just deduct them all up front when refinancing. Also, similar to real estate taxes, if a portion of your home is exclusively used for business, the related mortgage interest might be deductible on Schedule C for your business or on Schedule E if it's a rental property, rather than as an itemized deduction on Schedule A. Again, avoids double dipping.
Right. Keep business separate. Okay. Beyond home interest, what about interest paid on investments? If I borrow money to buy stocks, for example, is that deductible? Investment interest expense for individuals is indeed deductible, but there's a key limitation. It's deductible only to the extent of your net taxable investment income.
Only up to the investment income earned.
Exactly. Think of it like this. It's similar to the gambling loss rule. You can only deduct up to your winnings. For investments, you can only deduct the interest you pay on money borrowed to make investments up to the amount of income you generate from those investments in that year. This net taxable investment income includes things like interest income you earn, dividends, but generally not qualified dividends unless you elect not to claim the preferential lower capital gains rate on them, which is often not advisable, short-term capital gains, and royalties in excess of their related expenses.
What about interest for tax-free bonds?
Good point. It specifically excludes interest expense used to purchase tax-free bonds. Because the interest earned on those bonds isn't taxable income, the expense to generate it isn't deductible. Makes sense, right?
Yeah, no deduction for earning tax-free income. What if my investment interest paid is more than my investment income?
If your investment interest paid exceeds your net taxable investment income in a given year, the disallowed excess isn't lost forever. It can be carried forward indefinitely to future tax years, where it can be deducted when you eventually have sufficient investment income. This ensures you can't deduct a sort of net investment expense against other forms of ordinary income, like your salary. It only offsets investment gains.
Okay, carry forward is helpful. So we've covered home and investment interest. What about regular consumer interest? Credit cards, personal loans, car loans. Is that ever deductible as an itemized deduction? I bet a lot of listeners deal with that.
This is a big one to remember, and it's a simple, stark rule. Personal or consumer interest is generally not deductible, period.
Not at all.
Not as an itemized deduction. This includes interest on personal notes to a bank, interest on life insurance loans, interest on bank credit cards or store revolving charge accounts, and interest on purchases of personal property like cars, TVs, clothes, furniture. Even interest on federal, state, or local tax underpayments is considered personal interest and is not deductible as an itemized deduction. And again, to reemphasize that crucial point from earlier, a home equity loan whose proceeds are not used to buy, build, or substantially improve your home falls into this non-deductible personal interest category, even if it's secured by your house. So be very mindful of what you use borrowed money for if you're hoping for a tax deduction.
Okay, so personal interest is basically a no-go for deductions. What if you prepay interest? Like for a loan that spans multiple tax years, can you deduct it all in the year you pay it?
No, that's another common misunderstanding. Prepaid interest must be allocated and deducted over the period of the loan it actually covers, even for cash basis taxpayers. You can't just deduct it all in the year you pay it if it applies to future periods. It prevents manipulating deductions across tax years.
Right, spread it out. And what about student loan interest? That's a huge one for many people. Where does that fit in? Is that an itemized deduction?
Good clarification. Educational loan interest is actually an adjustment to arrive at adjusted gross income, AGI, often called an above-the-line deduction. It is not an itemized deduction on Schedule A.
Ah, so it's different. Why does that matter?
It's a very important distinction because it means it can be deducted whether or not you itemize your deductions. This offers a broader benefit to more taxpayers who are paying off student loans, as they don't need to clear the standard deduction hurdle to get this particular benefit. It reduces your AGI directly, which can then positively impact other AGI-dependent deductions or credits too.
Okay, that's a key difference. Now let's talk about something that feels good giving back. Charitable contributions. Many people donate, but can it also help your taxes? What are the specific rules? What counts?
Absolutely. Charitable contributions can lead to significant tax savings, and they're a vital part of the tax code encouraging philanthropy. But for them to be deductible, they must be made to qualifying charitable organizations recognized by the IRS. It's crucial to distinguish these from, say, non-deductible gifts directly to individuals, no matter how needy they are, or political contributions to candidates or parties. Those simply do not qualify for a tax deduction on Schedule A. You can always check if an organization is qualified on the IRS website's search tool.
Makes sense. Check the charity status. And how is the amount of the deduction determined? Is it just the cash amount? What about donating property, like an old car or some stock?
Yes, it definitely differs, and this is where it can get a bit complex. For cash contributions, it's straightforward. You generally deduct the actual amount paid. For property, however, it depends on whether it's classified as ordinary income property or long-term capital gain, LTCG property.
Okay, ordinary income versus long-term capital gain property. What's the difference?
Ordinary income property includes things like inventory from a business, capital assets you've held for 1 year or less, or investment property that has actually decreased in value since you acquired it. For this type of property, the deduction is the lesser of the property's adjusted basis, usually what you paid for it. or its fair market value, FMV, at the time of contribution.
So if it went down in value, you deduct the lower current value.
Correct. You don't get a deduction for the original higher cost if the value dropped. Now, on the other hand, for LTCG property, this is appreciated capital gain property held for more than 1 year. The deduction is generally its full fair market value at the time of contribution.
The full appreciated value.
Generally, yes. This includes things like appreciated stock you've held for years, real estate or other personal use assets like art or collectibles that have gone up in value. The key benefit here is that you get to deduct the higher appreciated value without having to recognize and pay capital gains tax on that appreciation. That's a powerful incentive.
That distinction is huge. Deducting FMV on appreciated assets is a big deal. But then there are also AGI limitations, right? These percentage limits that can get tricky.
They can be, yes, but understanding them is absolutely key to maximizing your deductions, especially if you're making significant contributions. The maximum allowable deduction in any given year depends on both the type of property you donate, cash, ordinary income, LTCG, and the type of charity you donate it to, like public charities versus certain private foundations. For instance, cash contributions to public charities are generally the most generous category, limited to 60% of your AGI.
60%. Oh.
Contributions of ordinary income property are generally limited to 50% of AGI. And contributions of that appreciated LTCG property are typically limited to 30% of AGI. Now, what's truly fascinating here, and often misunderstood, is how these limits interact when you have multiple types of contributions. They are applied in a specific cascading order.
An order. How did that work?
Yes. First, your cash contributions subject to the 60% limit are considered. Then contributions subject to the 50% limit, like ordinary income property, are considered, but the total can't exceed 50% of AGI minus the 60% contributions already counted. Finally, contributions subject to the 30% limit, like LTCG property, are considered, limited to the lesser of 30% of AGI or 50% of AGI minus the contributions already allowed under the 60% 50% rules.
Okay, that layering of limits sounds complicated.
Yeah.
A concrete example would really help illustrate how these AGI limits work in practice. Can you walk us through a scenario?
Absolutely. Let's use a hypothetical case with Joe Kelly. Let's say Joe has an adjusted gross income, AGI, of $100,000 for the year, and he itemizes his deductions. During the year, he was quite generous and made several different types of contributions. First, Joe donated $15,000 cash to the United Way, which is a public charity. Cash contributions to public charities are subject to the 60% AGI limit. 60% of Joe's $100,000 AGI is $60,000.
Okay, so $60K limit.
Right. Since his $15,000 cash contribution is well within that $60,000 limit, it's fully deductible in the current year. That's straightforward. Next, Joe donated some old personal furniture to Goodwill, also a public charity. He had bought this furniture years ago for $25,000, but its fair market value at the time of donation was only $10,000.
So it lost value. That makes it ordinary income property.
Exactly. Because it depreciated, it's ordinary income property. The deduction is the lesser of its cost basis, $25K, or its FMV, $10K. So Joe can deduct $10,000 for the furniture. This type of contribution is subject to the 50% AGI limit. Joe's overall 50% AGI limit is $50,000, 50% of $100. However, we need to account for the cash donation first. We apply the limits sequentially.
The sequence.
Right. His $50,000 limit is reduced by the $15,000 cash donation already counted towards it. Even though cash has its own 60% limit, it also counts against the 50% overall limit. So he has $35,000 remaining capacity under the 50% limit. $50,000 total limit, $15,000 cash used.
Okay, $35K left in the 50% bucket.
Correct. His $10,000 furniture contribution is well within this remaining $35,000 limit, so it's fully deductible this year. So far, he's deducted $15,000 plus $10,000, $25,000. Finally, Joe, being an art lover, contributed a valuable sculpture to a local art museum, another public charity. He bought it for $20,000 5 years ago, and its fair market value at donation time was $30,000.
Held more than a year. Appreciate it. So that's LTCG property.
Precisely. Long-term capital gain property. Contributions of LTCG property are subject to a 30% AGI limit. For Joe, that's $30,000, 30% of $100,000 AGI. However, the deduction for LTCG property is also limited by the remaining 50% AGI capacity. Remember, Joe started with a $50,000 capacity, 50% limit, used $15,000 for cash, and $10,000 for the furniture.
So $50K minus $15K minus $10K leaves $25,000 remaining in that 50% bucket.
Exactly. So for the sculpture, Joe can deduct the lesser of the 30% AGI limit, $30,000, or the remaining 50% AGI capacity, $25,000.
The lesser is $25,000.
Correct. In this case, he can deduct $25,000 for the sculpture this year, even though its FMV was $30,000.
So if I'm following this complex layering correctly, his total charitable contribution deduction for the year would be the sum of those three amounts.
Yeah.
The cash, the furniture, and the allowed part of the sculpture.
Precisely. For Joe, his total charitable contribution deduction for the year is $15,000 cash, plus $10,000 furniture, plus $25,000 sculpture allowed, equaling a grand total of $50,000 deduction for the year. And this is where the planning opportunity comes in. Since he donated a sculpture with an FMV of $30,000 but was only able to deduct $25,000 of it this year due to those interacting AGI limitations, the remaining $5,000 of that LTCG property contribution is not lost.
The carryover. So you don't necessarily lose the deduction if you hit the AGI limit in 1 year, especially if you're very generous. That's a huge relief for many donors making large gifts.
Exactly. This is a critical feature and a significant benefit. Any excess charitable contributions that couldn't be deducted in the current year due to these AGI limitations can be carried forward for up to 5 years. They are then applied on a first-in, first-out basis, meaning the oldest carryovers are used first, and they are still subject to the relevant percentage of income limitations in those subsequent years. This carryover provision ensures that your generosity eventually results in a tax benefit, even if it takes a few years to fully realize it. It's a key planning tool.
Good to know. What if you receive something in return for your contribution? Like you donate $200 and get a ticket to a charity dinner that's worth something. Does that affect your deduction?
Yes, it absolutely does. This is called a quid pro quo contribution. You can only deduct the amount of your contribution that exceeds the fair market value of the benefit or items you received in return. So using your example, if Joanne Vega buys a ticket to a charity ball for $200, but the actual value of attending the meal, entertainment, etc. was determined to be $50, she may only take a charitable deduction of $150. That's the $200 contribution minus the $50 value received.
Okay, deduct the donation part, not the value part. What about raffle tickets?
Raffle tickets, unfortunately, do not give rise to a charitable deduction at all. Because they offer a chance of winning a prize, the IRS views them as akin to gambling or purchasing a chance, not a pure charitable gift with no expectation of return.
Got it. No deduction for raffles. And timing. When does a contribution officially count for the tax year? Is it when you pledge or when the money actually leaves your account?
For cash or checks, it's when the payment is actually made or the check is mailed or delivered. For contributions made by credit card, it's deductible in the year the charge is made, even if you don't pay the credit card bill until the following year. Consistent with that cash basis principle again.
Okay, charge date for credit cards. What about volunteering your time? If I'm, say, a doctor or lawyer, volunteering my professional services for a charity, can I deduct the value of my time?
Unfortunately, no. You cannot deduct the value of your time or services rendered, no matter how valuable they are professionally. The IRS doesn't allow deductions for contributed services. However, you can deduct your out-of-pocket expenses incurred while providing services to a charity. This includes the cost of driving to and from your volunteer work.
Mileage.
Yes. For 2023, you could choose to deduct 14 cents per mile, or you could deduct the actual cost of gas and oil used for that volunteering, plus any parking fees and tolls you paid. So while your time is priceless, your actual expenses, including mileage, are deductible.
14 cents a mile for charity in 2023. Good to know. I've also heard something about a deduction for hosting an exchange student. Is that real? How does that work?
Yes, it is real, and it's a unique little provision. A charitable deduction may be taken for certain expenses incurred when you take a full-time student, like a foreign exchange student, into your home under a written agreement with a qualifying charitable organization. The student cannot be your dependent or relative. They must be in the 12th grade or lower, and they must be a full-time student for at least 5 months of the year. The deduction is capped at $50 per full month, meaning 15 or more days count as a full month, that the student lives in your home and attends school.
$50 a month. Not huge, but something.
Exactly. It's a small but tangible way the tax code recognizes this form of educational and cultural support.
Finally, for all these different types of contributions, cash, property, volunteering expenses, what kind of records do you absolutely need to keep? Substantiation seems critical in tax matters.
Substantiation is absolutely key. You nail it. For any cash contribution, regardless of the amount, you must keep records. This could be a bank record, like a canceled check, a bank or credit card statement showing the charity's name, date, and amount, or a written acknowledgement from the charity. That written acknowledgement must show the charity's name, the date, the amount, or description of non-cash property, and state whether you received any goods or services in return. You need this by the time you file your return.
Okay, bank record or letter for cash. What about property?
For non-cash property contributions over $500, you generally must file Form 8283, non-cash charitable contributions, with your return, providing details about the property and the charity. And for contributions of property valued at over $5,000 for any single item or group of similar items, with some exceptions like publicly traded securities, you generally need a formal written appraisal from a qualified appraiser, and you have to attach a summary of it to your return.
Wow, formal appraisal over $5.
Yes. This level of documentation is absolutely vital to protect your deduction if the IRS ever asks questions. Without the proper substantiation, your deduction can be disallowed, even if you genuinely made the contribution. Record keeping is non-negotiable here.
Okay, good advice. Now, let's turn to less pleasant events. What about losses from unexpected disasters, like a major flood or a wildfire? Can those be deducted as casualty losses?
Casualty losses of non-business property are indeed deductible, but their scope has been significantly limited in recent years by tax reform. They are now only deductible if the loss was sustained in a presidentially declared disaster area.
Only in a federally declared disaster zone.
Correct. So unfortunately, if a tree falls on your roof during a severe thunderstorm or a pipe bursts and floods your basement, those losses likely won't qualify for a federal tax deduction unless your specific county or area has received that specific federal disaster designation from the president for that event. This is a big change from prior law where more general casualty events could qualify.
That really narrows it down. And if it does qualify, being in a disaster area, what are the financial hurdles? Is it every dollar of loss?
No, there are two main financial thresholds, which, combined with the disaster area requirement, make it quite difficult for many to actually claim these losses, even when they occur in a declared disaster. First, each individual casualty loss event must exceed $100. That's a $100 floor per event. Then, the aggregate of all your eligible casualty losses for the year, after applying that $100 floor to each one, must exceed 10% of your adjusted gross income, AGI.
10% of AGI, that's another high bar, like the medical one.
It is. So if your AGI is, say, $50,000, your total eligible casualty losses for the year, after the $100 floor per event, would need to be greater than $5,000, 10% of $50K, before any deduction can kick in. Only the amount above that 10% AGI floor is deductible. This combined floor system means only very substantial qualified losses will ultimately result in a tax deduction.
Okay, so it has to be big in a disaster area and exceed these floors. How do you calculate the actual amount of the loss for tax purposes? Is it just the cost of repairs or what you originally paid for the damaged property?
Not necessarily either of those directly. The amount considered a casualty loss for tax purposes is the lesser of two figures. Number one, the property's decrease in fair market value immediately after the casualty. So the difference in value right before versus right after the event. Or number two, the property's adjusted basis right before the casualty.
Adjusted basis that's usually cost plus improvements minus any depreciation taken, right?
Generally, yes. So you figure out both the decrease in FMV and the adjusted basis. Whichever of those two amounts is lower, that's your starting point for the loss calculation. Then that amount must be reduced by any insurance recovery or other reimbursement you receive or expect to receive.
Insurance payout reduces the loss.
Always. For example, if your property's adjusted basis was $100,000 and its fair market value decreased by $30,000 due to a qualifying hurricane, your potential loss starts at $30,000, the lesser of a $100 K basis or 30K FMV decrease. If you then receive $10,000 in insurance proceeds, your loss for tax calculation purposes becomes $20,000, $30,000 initial loss minus $10,000 insurance. That $20,000 would then be subject to the $100 per event floor and then aggregated with other losses to see if it clears the 10% AGI floor.
So filing an insurance claim seems absolutely essential if you have coverage.
Yes. A casualty loss for non-business property generally cannot be deducted unless an insurance claim was filed if the loss was covered by insurance. Or, of course, if the loss was simply not covered by insurance at all. You can't just choose not to file an available insurance claim simply to get a potentially larger tax deduction. That's not allowed.
Makes sense. And it's worth noting, you said earlier, this isn't for just losing something, right?
Correct. No casualty loss deduction is allowed for simply lost, misplaced, or accidentally broken property. It has to be damage or destruction from an identifiable event that is sudden, unexpected, or unusual, and again, for current law, within that presidentially declared disaster area context for personal losses.
Okay. Now, we used to hear a lot about miscellaneous itemized deductions, often subject to that 2% of AGI floor. Things like unreimbursed employee expenses, union dues, tax prep fees. What's the current status of those? Are they still around?
This is another really important change from the Tax Cuts and Jobs Act that caught many taxpayers off guard and significantly reduced itemized deductions for some. The law suspended all miscellaneous itemized deductions that were previously subject to the 2% of AGI floor.
Suspended, meaning gone for now.
It's exactly gone for now. This suspension applies for tax years 2018 through 2025. So currently, and through at least 2025, unless the law changes, they are simply not deductible on Schedule A. This means common categories like unreimbursed employee business expenses, think mileage for work not paid back, home office expenses for employees, work uniforms, professional dues, job search costs, also tax preparation fees, investment advisory fees, and safe deposit box rental fees used for investment documents. All those things which were once deductible for many taxpayers if they exceeded 2% of AGI are now completely gone from Schedule A for these years.
That's a huge change. Removes a whole swath of common deductions people used to take.
Wow.
Okay, one last specific category. Gambling losses. Are those deductible for folks who enjoy a trip to Vegas or playing the lottery?
Gambling losses are indeed deductible, but there's a very specific, very strict rule. They are fully deductible as an itemized deduction, not subject to that 2% floor even when miscellaneous deductions existed, but only to the extent of gambling winnings reported elsewhere on your return.
Only up to the amount you won.
Correct. You cannot use gambling losses to reduce other types of income you might have, like your salary or business income. You can only use them to offset the amount of gambling winnings you report as income. For example, if you won $5,000 playing poker during the year, but you lost $7,000 betting on sports, you can only deduct $5,000 of your losses on Schedule A. This brings your net taxable gambling income to zero. 5,000 winnings, $5,000 deductible losses. You cannot deduct the extra $2,000 of losses against your other income. The excess loss just disappears for tax purposes.
So break even at best for tax purposes.
Exactly. And it's critically important to keep meticulous records of both your winnings, which are taxable income, and your losses, which can offset those winnings if you engage in any gambling activities. You need proof for both sides.
Good advice. Keep those records. Okay, we've covered a tremendous amount of ground, breaking down each major category of itemized deductions: medical, taxes, interest, charity, casualty, and even those suspended miscellaneous ones, and gambling. Now, let's try to connect all of this to the bigger picture by looking at a real-world type of scenario. This is where understanding these rules can truly help you identify opportunities for savings, or maybe even spot potential red flags in your own tax planning or preparation.
Exactly. Let's consider the case of, say, Alice Adams. She's a single taxpayer who conscientiously itemizes her deductions every year. In year one, her total itemized deductions came out to $16,000. But then, in year two, her deductions jumped significantly, more than doubling to $33,500. Meanwhile, her adjusted gross income remained pretty consistent. Let's say it was $100,000 in year two. A shift this dramatic, going from $16,000 to $33,500 in deductions on similar income always warrants a much closer look. It strongly suggests something substantial has changed in her financial life, or perhaps how her return was prepared.
That's a huge leap in deductions for Alice, almost $18,000 more. If you were looking at her return as an expert, what specific areas would you investigate first? What questions would immediately pop into your head seeing that big jump?
Well, we'd want to dissect the changes in each major category on her Schedule A to understand the underlying story. What drove that increase? First, let's look at her medical dental expenses. Suppose they went from $0 in year one to $5,000 in year two. Now, what's truly fascinating here, and a critical insight for anyone looking at medical deductions, is thinking backwards from the deduction. To achieve a $5,000 deduction after meeting the 7.5% AGI floor, which for Alice with a $100,000 AGI is $7,500. She must have had a total of $12,000 deducted plus the $7,500 floor amount she had to overcome.
$12,500 in actual medical costs.
Right. That immediately raises an important question for you, the listener, if you see a similar jump. Was there a major medical event? A significant health issue, maybe surgery, or a period of high medical needs in year two? And crucially, was all potential insurance reimbursement fully accounted for in calculating those expenses? This kind of increase often indicates a significant life event, not just minor fluctuations in healthcare spending.
Good point. Need to trace it back to the actual spending. What about taxes?
Okay, let's say her real estate taxes increase significantly, maybe from $3,000 in year one to $5,500 in year two. That's a substantial $2,500 jump. This could strongly indicate that Alice purchased a new, perhaps more expensive home in year two, or alternatively, it could be due to a major property tax reassessment in her current location, maybe because she made significant home improvements that increased her property's assessed value, or perhaps just rapidly rising property values and tax rates in her area.
So the question for the listener is, did you move? Or did your property taxes just go way up for some reason?
Yeah. Precisely. Understanding the why behind the increase is key. Then, let's say her home mortgage interest also saw a substantial increase, going from maybe $5,500 in year one to $8,500 in year two. This $3,000 increase, particularly when you see it alongside the rise in real estate taxes, further strengthens the possibility that Alice might have purchased a new, more expensive home and therefore took on a larger mortgage. However, it could also potentially be due to refinancing an existing mortgage, though that often lowers interest, or perhaps taking out a home equity loan specifically for qualifying home improvements, which would make that new interest deductible.
So get free listening.
Yeah.
What changed with your mortgage this year? A new purchase, refi, home improvement loan.
Gotta know the reason.
Exactly. The reason dictates the deductibility, especially with that use of funds rule for home equity debt. And finally, let's look at charitable contributions. Suppose they jump dramatically from, say, $1,000 in year one to $10,000 in year two.
Wow, a tenfold increase. Right. A $9,000 increase. This is a staggering leap, and honestly, in real-world tax preparation scenarios, a jump this large often flags a potential input error first. Perhaps an extra zero was typed in by mistake. Or maybe a donation was miscategorized. Before assuming genuine extreme generosity, it's absolutely crucial to confirm the actual amount with solid source documents, acknowledgement letters from the charities, canceled checks, bank statements. Ensure the number is correct.
So the question for you is, do your charitable records, your proof, truly match such a substantial increase?
Yeah.
Or could this be an area where a simple typo might be inflating your deductions accidentally? Good record keeping is your best friend here, like you said before.
Absolutely. It protects you and ensures accuracy.
This Alice Adams example, even hypothetically, really shows how each of these categories, when you look at them together, tells a powerful story about financial activity and decisions made during the year. For you, the listener, it's about being proactive, understanding what each line item on your potential Schedule A signifies not just for the sake of filing your taxes correctly, but for planning smartly throughout the year. It truly is about being informed and asking the right questions about your own financial life, allowing you to optimize your tax position legally and effectively.
Absolutely. The ultimate goal here is to move beyond just basic compliance, just filling out forms, to a truly strategic understanding of your tax situation and how your financial choices impact it.
Well, we've certainly taken a deep dive today into the intricate, sometimes confusing, but really important world of itemized deductions. We've gone from the high hurdles of medical expenses and the sometimes painful limitations of state and local taxes to the nuances of different types of interest deductions and the powerful planning opportunities around strategic charitable giving. It's clear that understanding these rules, how they interact, and how they apply to you is your personal shortcut to being exceptionally well-informed. And perhaps more importantly, it's your pathway to potentially keeping significantly more of your hard-earned money right where it belongs in your pocket.
And this raises, I think, an important final question for you, our listener, to ponder. Beyond just filing your taxes once you're looking backward, how can knowing these detailed deduction rules actively influence your financial decisions and your planning throughout the entire year looking forward? Could proactive planning, like maybe strategically bundling several years of charitable contributions into a single year to get over the standard deduction hurdle or maximize impact under AGI limits, or perhaps carefully structuring a home improvement loan to ensure the interest is fully deductible under current rules, could that foresight ultimately put more money back in your pocket? Not just this tax season, but consistently, year after year. It's not just about what happened last year, but about what you can strategically make happen next year.